Good morning. We are happy to welcome you at this second webinar of the series that OFI Asset Management has organized until the end of June. First of all, I would like to remind you, for those who did not have the opportunity to attend the last webinar, which was dedicated to the precious markets, that it is available on our website, www.ofi-am.fr. Today, the webinar will focus on the short-term segment of the investment grade market, and it will be animated by Yannick Lopez, Head of Fixed Income at OFI Asset Management. So good morning, Yannick.
Morning.
Following the recent market evolution, can you tell us what really happened to the credit short-term market, which is traditionally resilient? Is it really the case? And do you think we can consider it as a good investment opportunity?
Yes, thank you, Christophe. You're right, we just experienced a massive repricing of the risk during the last 2 months on all asset class. The credit market as a whole, and also the short term, has not been immune. From the end of February, we have seen large credit spread widening, as described on the graph on your left, page 2. This is due, of course, to the collapse of the economic forecast and the impact on the business activity of the issuers. Clearly, some sectors are more impacted than others. The risk of rating downgrades for a lot of issuers is very important. Some already took place. The automakers like Renault or Ford, the airliner Lufthansa, for example. The huge spread widening on the euro short-term credit market is also due to the lack of liquidity. Banks don't have large books, most none. So in such context, banks are functioning as brokers. They only cross deals. As a consequence, when bondholders have had to sell, there was a lack of bids, a lack of liquidity, even on IG issuers and especially on the short-term duration. To some extent, that creates opportunities for those who have cash to invest, clearly. Back to the widening graph on your left, still page 2. The IG short-term has seen its average spread jumping from, say, below 40 to almost 200 basis points in a very short period. This is, of course, largely above the recent peaks observed since the ECB engaged in its zero interest rate policy and its successive quantitative easing programs started in 2014 and after. Admittedly, it's well below the widest level observed during the great financial crisis in 2008, early 2009. But there is a big difference. At that time, as I said, ECB was not engaging in its ultra-loose monetary policy and was not buying back large amounts of debt, including corporate debts. In terms of yield, graph on your right, it has been nowhere around 0% since several months, including below 0% at the end of 2019. Now it stands at 1.15% after reaching 1.6% in March. Of course, again, these levels are well below those observed in 2011 and 2008. But again, there is a big difference. The ECB's rates were well above at that time. Page 3 now. In the widening, the spread curve has flattened. What does that mean, flattened? It means that the short-term part has grown more than the longer part of the curve. The 1 year to 3 year segment has widened 110 basis points when, in the meantime, the longer less than 100. As a consequence, as you can see on the graph on your right, the spread curve is now roughly flat. At this level of spread and yield, we calculate that another leg of 32 basis points credit spread widening would wipe out the excess return of the global IG market over 1 year. See on the graph on your left. It also shows that the best place to be for us, from a risk-return point of view, is the short end of the market, where more than 100 basis points spread widening are needed to clear the excess return. For us, is a buy. Page 4 now. If we are strongly convinced that the investment grade short term, say below 3 year, is a buy, we think that the overall Euro investment grade market has to be considered as an interesting investment right now. The carry is better than it was. The spreads have widened sharply, and there are technical factors that support this asset class. And first of all, the very large asset purchases programs of the ECB. Initially launched at the end of 2014, and then the next 2 years after, different programs have been put in place by the ECB in order to revive the inflation and support the economy in maintaining very low financial conditions. Recently, to cope with the massive drop in economic activity and financial markets, the ECB has decided to restart the net purchases, which have been stopped at the end of 2018. The volume of net purchases is huge, more than 100 billion euro per month in theory and for 2020. In theory, because the exact amount per month is unclear, because the main program recently announced by the ECB in March, the Pandemic Emergency Purchase Program, or so-called PEPP, is said to be flexible. This PEPP, which is huge, 750 billion euro to spend until end of 2020, can buy sovereign bonds and corporate bonds. The mix has not and is not for the moment disclosed, but we can say that one thing is very clear. First, the ECB is a large bond buyer. This includes corporate bonds. This will stand in place for a very long time, and so this is very supportive for this asset class, definitely. Page 5 now. As I just said, investment grade credit market valuation will be supported because the ECB is a big buyer of bonds and for a long time, okay. But it is also supported because the short-term rates will stand very low for a very long period. As shown on the graph on your left, the market does not anticipate any ECB rate hike for a while. Admittedly, the market no longer anticipates any rate cut neither. So keep in mind that the money market rates will stay in a negative territory for several months again and probably years. This is especially due to the fact that the excess liquidity is and will stay very abundant. And at one time, the carry on bonds will be hunted again, which is good news once more for the strategy we discussed now. Page 6 now. OFI has an investment vehicle which focuses on the Euro investment grade short maturity bonds. Let me describe it in short. Its investment strategy is quite simple. This is a long-only fund. It is actively managed regarding its interest rate and credit exposure. It invests in euro investment-grade corporate bonds that have a minimum remaining maturity of 3 years. As a diversification, it can invest up to 10% of its net asset value in euro high-yield bonds. But keep in mind that this ratio of 10% cannot be exceeded even in the case of a downgrade from investment grade to high yield. We can also expose the fund to an issuer's credit via credit default swap, CDS. But the same rules in terms of maturity and rating must be respected with this CDS. The investment process includes socially responsible investment based on our high dedicated research team. Lastly, the interest rate sensitivity is managed in a range of 0 to 2 points. Page 7. The fund has returned a consistent and smooth performance every year since its launch in 2009. In the last years, it has been a good response to the negative returns you had on the monetary market. In 2020, the year-to-date performance is obviously negative, with the large credit spread widening, but also with the rise in interest rate during the crisis in March. As a consequence, the fund has experienced a large drawdown in comparison with its history. We think this is a really good point of entry. Why to invest in this strategy when the credit market sell off? Because the time to recovery after a significant drawdown is short, as I mentioned on the graph on your left. The reason is the bonds you have in your portfolio are short-dated bonds. The default risk is very low on investment-grade issuers, and for such short maturities, the price of the bond will reconverge quickly to the redemption price after a sell-off. We think this is what will happen again. The fund should recover its fall in a short period of time, even admittedly if it takes a little bit longer due to the economic situation we have now and the low visibility we have at the moment. Page 8. The fund has an investment process which aims to invest all along the maturity spectrum, but within its limit of 3 years at maximum, as the graph on the top left shows. The advantage is you always have, by this way, natural redemptions to reinvest, which is interesting when spreads and or rates go up. So you can take advantage of higher yields. The breakdown by rating shows a focus on the BBB issuers, which mixed solid financial metrics and good yields. The main statistical data of the portfolio to focus on, bottom right, are an average yield of 1.49% for an average maturity of 1.45 years. Secondly, an interest rate sensitivity of 1.28 for a credit sensitivity of 1.77. Page 9 now. The fund is very well diversified in terms of sectors. No surprise, the banks lead the breakdown. Bottom right, as I previously mentioned, we include in our bond picking an SRI approach, which tends to promote the best-in-class issuers instead of the less involved ones. Page 10, I will let you take a look at the administrative characteristics on that page. And I would like to thank you for your attention.
Thank you very much, Yannick. We just received one question that I would like to ask you, and that concerns the market liquidity. So what is exactly the liquidity level, and what has it been during the stress period, and what is it now, please?
Yeah, thank you. Clearly, the liquidity has been a subject in that period. As I said previously, the widening of the spread has been explained by the lack, partly by the lack of liquidity. The banks don't have books. That means that they only cross deal. So when everybody is in the same way, when you need to sell in such a stress of market, clearly nobody can make bid. And in March, clearly the liquidity was a problem. It's a fact. Sometimes you ask a request to sell, and you only have no bid, nowhere. It was not the same case in 2008, for example, because at that time banks had books and could take on their book papers, bonds. At the moment, clearly the liquidity has improved, and it's a good thing. We can thank the ECB for that. We can thank the market because the market have improved, and probably investors are less scared to take some advantage of the level of the market and return to the market. And clearly, right now, you see on the short-term investment grade market, a lot of bid, a lot of buying access, and on the opposite, almost no offer. So liquidity to sell is quite very good right now. It has been a problem in March. I think it will be better and better in the weeks next weekend and next month.
Thank you very much,
for you?
Yannick. So thank you very much to all of you. I would like to remind you that we will hold our next webinar on the 7th of May, and it will address our market views and outlook, and of course present our asset allocation. Thank you very much.